Realty Income is widely considered one of the most popular REITs on the market today, well known for their monthly dividend. After all, the company coined themselves the monthly dividend paying company. However, the REIT is much more than a company that pays a monthly dividend. For years, they have been the epitome of consistency, consistent year in and year out. However, in the year 2023, Realty Income has been anything but consistent from a share price performance. With shares down more than 20% in 2023 and yielding a dividend of 6.4%, which is rarely seen from Realty Income, is now the time to buy the stock, or is this just another falling knife? We're going to take a look at the REIT in today's video. But before we begin, do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content. And with that being said, let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we start today's video, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. Now back to our video talking about the gold standard of REITs. And when you look at Realty Income, looking back at the summer of 2022, you saw that the company had a market cap of more than $45 billion. Fast forward today, and Realty Income has a market cap that is at $34 billion. They have shed more than $10 billion over that time span. Here's a look at how consistent the company has been over those years outside of 2023. Since going public in 1994, Realty Income has generated compounded average annual returns of 14.2%. In the last 27 years, the company has generated positive earnings per share growth in 26 of those years. And they have a 5% median AFFO per share growth since 1996. The REIT has a portfolio that consists of more than 13,100 properties, a number that's only going to rise with the pending acquisition of Spirit Realty, something we're going to talk about here in a second. In addition to the large portfolio of properties, the company has seen strong demand for their properties, evidenced by the high 99% occupancy rate, which just speaks to the quality of the company's portfolio. The portfolio is leased out to more than 1,300 different clients, which also spreads out the risk as well. Here's a look at the company's top 20 tenants. At the top, you can see the likes of Dollar General, Walgreens, and Dollar Tree, which make up more than 10% of annual base rent. What for years investors has seen as a strength, the top of that tenant portfolio being high quality companies, has been flipped as Walgreens, Dollar Tree, and Dollar General have all been under intense pressure here in 2023. Looking at the share price of those three, you could see Dollar General down 53% over the past 12 months, Walgreens down 40% over the past 12 months, and Dollar Tree down 25% over the past 12 months. Again, these top three tenants account for nearly 11% of the company's annual base rent. Given the size of the portfolio, management still does a great job always trying to work with tenants that are high quality, yet still only 40% of their tenant base is investment grade tenants. Management likes to state that their portfolio is insulated from the changing consumer behavior to a degree, given their exposure to service-oriented and non-discretionary categories. Even with all of this, Realty Income is still in a search for growth. The company dating back to 2021 and 2022 saw AFFO growth of 9%, which was solid for the REIT. However, in 2023, AFFO is only expected to grow 2%. Given that Realty Income is a net lease REIT, this means that a lot of the typical landlord costs are passed on to the tenant. Think of things like insurance costs, property tax, and maintenance costs are all passed over to the tenant. Therefore, Realty Income owns the properties and collects a rent check. However, at the same time, it's a little bit more difficult to drum up organic revenue growth. Really, the only way to do it is through lease escalators. And how are lease escalators negotiated? Well, usually they're either a fixed lease escalator or they could be tied to things like inflation. And Realty Income has a good number of their leases tied to inflation, which can be a tailwind for the company moving forward. However, given all of that, Realty Income is clearly in a search for growth. That's why they went out and acquired the likes of Spirit Realty, another net lease REIT with a lot of similarities in terms of tenants and the way they operate. In doing the deal, the $9.3 billion is an all-stock deal, meaning that Realty Income issued new shares, which diluted current shareholders, hence why we saw the stock drop nearly 8% following the announcement of this acquisition. The transaction is expected to add 2.5% to AFFO and add synergies of $50 million, which is actually a lot less than I expected. Spirit has a portfolio of more than 2,000 properties across 49 states, and here's a look at SRC's top 20 tenants. Looking at the top tenants, you could see some crossovers with Lifetime Fitness, BJ's Wholesale, Home Depot, Walgreens, just to name a few. The top 20 tenants account for 35.2% of annual base rent. And in return, this acquisition is actually going to decrease the company's exposure to investment-grade tenants, as SRC has only 18% investment-grade tenants. The occupancy rate is still quite strong for SRC, very similar to that of Realty Income, as SRC has an occupancy rate of 99.6% with a weighted average lease term of 10.2 years. So we're talking about very long lease agreements. In addition, Realty Income will also be assuming SRC's $4.1 billion worth of debt. However, the debt does have a low rate of just 3.48%. Although assuming more debt is nothing I like to see, at least it's a low rate. And the company has adjusted debt to annualized adjusted EBITDA of 5.3 times. However, as I alluded to, Realty Income having a lot of leases that are tied to CPI, Spirit Realty is actually the complete opposite, as only 13% of their leases are tied to inflation, with the rest being fixed. The transaction is expected to close in Q1 of 2024. So given all of this that we looked at, and even before the acquisition, shares of Realty Income have really been in the investor doghouse as we looked at how far the shares have fallen. So right now, are shares a great buy at a great valuation, or is this just another falling knife? And I think it's important to put things into perspective, because if you're looking for a stock that's going to add a ton of growth, then Realty Income is likely not the stock for you. However, if you're value hunting, looking for a high quality REIT to add that real estate exposure, trading at a great valuation with a very high dividend yield over 6%, then Realty Income might be just the stock you're looking for. Analysts are looking for AFFO of $4.14 per share in 2024, which has shares of O trading at an AFFO multiple of just 11.6 times. To understand just how low this is, let's take a look at the 5 and 10-year average of Realty Income, which is at 19.2 times for both of those periods. That is a huge discrepancy we're talking about. Realty Income also yields a dividend that has not been seen for many years, but they currently yield a high dividend of 6.4%, and they have paid a growing dividend for more than 25 consecutive years, making them a rare REIT on the Dividend Aristocrat list. The company pays their dividend monthly and actually increase it every quarter. Even though the yield has ballooned higher, I still believe the dividend is plenty safe at the moment based on its AFFO coverage. When it comes to Realty Income, there is still some things to be concerned about. But one thing you don't have to be concerned about is valuation and a high quality management looking to turn things around. They are taking advantage of these suppressed valuations to increase their portfolio and strengthen their portfolio. They already have a high quality balance sheet, a great management who makes great decisions year in and year out, and I believe they're going to come out of this stronger. They may not flip the script overnight, but at an 11 times multiple, I think the floor is in, and there's a lot more return ahead for value investors and long-term investors willing to be patient. Down in the comments section below, let me know your thoughts. Do you believe Realty Income is a great buy at 11 times multiple, or do you still believe there's more pressure that the stock will go down even further from here? And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.